So you look at a global bank, right, reporting $27.3 billion in quarterly expenses. And, well, your very first instinct is probably to just assume it's massive corporate waste.
Oh, sure. Yeah, it sounds like it.
I mean, that is just an astronomical amount of money just to keep the lights on. But when you actually dig into Jeremy Barnum's latest CFO remarks, the one we're looking at today, that massive expense sheet isn't really a red flag at all.
No, not at all.
Right. It is actually this, real-time X-ray showing how labor inflation is just fundamentally rewiring Wall Street. And, more importantly for you listening, it shows us exactly what is happening inside the wallets of everyday consumers.
Exactly.
It breaks down the mechanics of these massive corporate deals, and it shows where the world's wealth is aggressively moving as we head toward 2026. So welcome to today's deep dive.
It's honestly the ultimate diagnostic tool. I mean, an earnings report at this specific scale, it starts being just a corporate scorecard,
Yeah.
It becomes a mirror held up to the entire global market.
Yeah, totally.
When an institution is processing trillions of dollars in assets, they don't just participate in the economy. Their balance sheet literally reflects the underlying physics of it.
Okay, let's unpack this. Because the sheer gravity of these numbers is, it's something we really need to anchor ourselves to before we get into the weeds.
For sure. Start with the top line.
Right. So starting with the overarching financial metrics that set the tone for this whole quarter, the firm delivered a net income of $16.9 billion.
Massive.
Yeah. And EPS earnings per share came in at $6.14. And they posted a return on capital, or ROC, of 23%. Plus, excluding some significant items noted in the report, their revenue jumped 15% year on year.
That 23% ROC is the metric that should really command everyone's attention here.
Wait, really? More than the $16 billion in profit?
Oh, absolutely. I mean, to generate a 23% return at this sheer volume of capital, it requires an operation that is just running at peak structural efficiency.
Right, because it's so hard to steer a ship that big.
Exactly. It means for every single dollar of capital deployed, whether that's, in traditional lending or massive markets financing, they are extracting a highly optimized yield.
Wow.
You don't hit 23% by accident. You hit it because the plumbing of your institution is like capturing margin at every possible choke point.
Right, but capturing that margin is costing them heavily, right? Which brings us back to that $27.3 billion expense figure.
Yeah, that's a trade-off.
Because that expense line is also up 15% year on year, perfectly mirroring the revenue jump. Now, the CFO explicitly cites volume and revenue-related expenses, which, is standard. Like, if you are doing more business, your processing and execution costs rise.
Of course.
But he also deliberately calls out growth in front office hiring and labor inflation. So I look at a 15% expense jump driven by human capital costs, and I have to wonder, is this purely a sign of healthy structural growth? Or is this like a flashing warning sign that labor inflation is permanently eating into their bottom line?
Well, the phrasing labor inflation is definitely doing some heavy lifting in Barnum's remarks.
Right. It stood out to me.
Yeah, because in high-level finance, human capital isn't just a line item. It is the primary engine of revenue generation.
They're paying for the brains.
Exactly. Front office hiring means they are fiercely competing for the deal makers and the traders who actually bring in that 15% revenue bump.
Okay, that makes sense.
However, by acknowledging labor inflation so directly on an earnings call, management is basically signaling that the baseline cost of retaining elite talent has permanently shifted upward.
So it's the new normal.
Yeah. It isn't a panic scenario, but they are openly admitting that to maintain that 23% ROC, they just have to pay a steep premium for the people pulling the levers.
And speaking of pulling levers, let's talk about how they're managing their actual capital cushion.
The balance sheet.
Right. So the text states they ended the quarter with a standardized CET1 ratio of 14.1%, which is actually down 20 basis points versus the prior quarter.
Right.
And simultaneously, their risk-weighted assets, their RWA, grew by a massive $103 billion.
Which is a huge jump.
Yeah. And my first thought when I see a dropping CET1 ratio is vulnerability, right? Like their safety net is shrinking.
That's the natural assumption, yeah.
But given the sheer scale of that RWA growth, are they actually just stretching their legs and aggressively deploying capital to capture yield in this kind of environment?
That is the exact dynamic at play here. A 20 basis point drop in CET1 isn't the defensive retreat. It's actually the mathematical result of an aggressive offensive strategy.
Oh, interesting.
Yeah. The CFO notes that the $16.9 billion in net income was more than offset by two primary factors. The first is capital distributions.
Right, the dividend.
Yes. The board announced a dividend increase to $1.65 per share for the third quarter, which is them aggressively handing capital back to shareholders.
Got it.
And the second, and honestly more mechanically important factor, is that $103 billion RWA expansion.
Which the text attributes largely to financing across their markets, business, and growth in traditional lending.
Yes. So when a bank aggressively finances market activities, say, providing leverage for prime brokerage clients or expanding their loan book, they are rapidly inflating the denominator of that CET1 ratio.
They're intentionally putting their core equity cushion to work.
Exactly. They aren't just hoarding cash. They are actively absorbing more risk-weighted assets because the current yield environment makes it highly, highly profitable to do so.
So the bank is aggressively deploying capital. But to fund a $103 billion asset expansion, you need massive, stable liquidity.
You need a lot of cash, yeah.
And the primary engine generating that liquidity doesn't sit on a trading floor in Manhattan. It sits in the checking accounts of everyday people.
That's the reality of it.
So let's look at the consumer and community banking data, the CCB, because the consumer numbers here are acting like this massive financial counterweight.
Yeah, the sheer volume of consumer liquidity is what allows the corporate side to operate at such a high velocity. I mean, the CCB is the absolute foundation.
And the foundation is incredibly active right now. CCB reported revenue of $20.3 billion, which is up 8% year on year.
Huge numbers.
Driving a net income of $5.3 billion. And the growth drivers are pretty textbook. They cite higher card net interest income, or NII, on higher revolving balances.
Right.
Higher operating lease income in auto, and higher asset management fees. Plus, they saw over 500,000 net new checking accounts opened, average deposits are up 3%, and client investment assets spiked a staggering 21% year on year.
It's just massive growth across the board.
They even refreshed the Sapphire Preferred card in June, but, the text highlights this really stark contradiction.
Yeah, Barnum mentions the macro environment.
Exactly. Barnum explicitly points out that consumers are facing elevated gas prices and persistent inflation. So it feels like this financial gravity-defying trick.
It really does.
I mean, how on earth are everyday people swiping newly refreshed Sapphire cards and driving a 21% spike in investment assets when the baseline cost of living is just squeezing them so hard?
Well, what's fascinating here is the precise macroeconomic tension that the CFO outlines.
Okay.
The micro pain is very real. Gas prices, grocery bills, those are constant frictions for you, the listener, and for everyone else. But Barnum points to the structural counterweights.
Like what?
Mainly higher tax refunds and a profoundly solid labor market. Basically, the macro is simply overpowering the micro.
Yeah, so as long as they have jobs.
Exactly. When people feel inherently secure in their employment, their spending behavior doesn't contract, even if the cost of the goods they're buying goes up.
Wow. And that behavior directly feeds the bank's NII, specifically on those revolving credit card balances.
Exactly. Let's look at the mechanism of that NII growth. When the consumer is stretched by inflation, but is still employed, they don't stop spending.
They just pull out the plastic.
Right? They transition that spending onto credit and carry the balance month to month.
Which hurts the consumer,
But it is a massive margin generator for the bank. While that revolving debt creates an interest burden for the individual, the bank captures the spread. So inflation friction for the consumer translates directly into aggressive NII growth for the institution.
That makes so much sense. And it isn't just debt either. That 21% spike in client investment assets shows that the consumer isn't just like treading water.
No, not at all.
The people with surplus liquidity are aggressively putting it to work.
Yeah, and the CFO attributes that to market performance and strong flows. It tells us that the consumer base is highly bifurcated right now.
Split in two.
Right. One segment is carrying higher revolving debt just to maintain their lifestyle, which drives NII. The other segment is capturing high yields in the market, which drives wealth management fees. And the bank is perfectly positioned to monetize both ends of that consumer spectrum.
Incredible. So Main Street is generating all of this liquidity, parking it in checking accounts, and paying interest on revolving balances. But the bank doesn't just sit on those consumer deposits.
Definitely not.
They channel that massive liquidity directly into the corporate and investment bank to finance high-level corporate maneuvering, which brings us to Wall Street's blockbuster quarter.
Yeah, the CIB results are where you really see that consumer liquidity just weaponized into corporate action.
The numbers here are explosive. The CIB delivered $9.7 billion in net income on $24.9 billion in revenue.
Up 27% year on year.
Yeah, 27%. Investment banking fees surged 30%, which the text attributes to strong equity underwriting and the accelerated closure of M&A transactions.
So deal making is back.
Big time. And fixed income was up 6%, showing strength across credit, currencies, and emerging markets, despite a drop in commodities. But here's where it gets really interesting.
The equities desk.
Yes. Equities revenue delivered an 86% year-on-year jump. 86%.
It's a massive spike.
Driven by what the CFO calls dynamic market conditions, strong flows, and heavy prime client activity. But, I have to push back a little on the enthusiasm around this number.
Fair enough.
Is an 86% spike in equities revenue a sign of a fundamentally healthy, robust market? Or is this kind of extreme volatility actually a symptom of a chaotic, overheated trading environment where clients are just scrambling to hedge their risk?
Well, if we connect this to the bigger picture, you have to look at how a trading desk actually captures revenue. In Wall Street parlance, the word dynamic is really just a polite synonym for highly volatile.
Right. Code for chaos.
Exactly. And volatility is the absolute lifeblood of an equities desk. Think of the bank's trading infrastructure like a massive energy grid during a historic heat wave.
Okay, I like that. So they aren't betting on the temperature. They are just charging a toll for the massive surge in electricity moving through the wire.
That is the exact mechanism. When markets are shifting violently, large prime brokerage clients like hedge funds, institutional managers, they have to aggressively adjust their positioning.
They can't just sit still.
No. They need to delta hedge their portfolios, which drives massive volume in derivatives. They need to move liquid assets instantly, which drives cash trading. And the bank facilitates all of that frantic activity.
Taking a cut every step of the way.
Precisely. So an 86% revenue spike doesn't mean the underlying corporate economy is 86% stronger. It simply means the environment was hyperactive and the bank successfully captured the spread on all that chaos.
Okay, but the other side of the CIB, the investment banking fees being up 30%, that points to actual structural moves, right? Not just trading chaos.
Oh, absolutely. And this is where the corporate narrative complements the consumer narrative we discussed earlier. Well, the CFO highlights strong equity capital markets deals and the acceleration of M&A closures. But more importantly, he notes that the deal pipeline remains quite robust.
Meaning more deals are coming.
Right. When mega corporations are actively engaging in mergers and acquisitions, they are making massive, irrevocable long-term bets on the future trajectory of the economy.
Because you don't buy a company if you think the sky is falling.
Exactly. They do not commit billions in M&A capital if they believe the consumer is about to collapse. The corporate confidence you see on Wall Street is a direct derivative of the consumer resilience we saw on Main Street.
Wow, it really is this massive closed-loop ecosystem. You have everyday folks generating liquidity and carrying revolving debt. You have mega corporations aggressively trading, hedging, and merging. And all of that friction, all of those fees, they have to aggregate somewhere. So where does the resulting long-term wealth actually sit? That brings us to asset and wealth management and the highly anticipated 2026 outlook.
The AWM numbers show the ultimate consolidation of this entire financial cycle.
Yeah, so AWM reported a net income of $2 billion on $6.9 billion in revenue, which is up 19%. And the efficiency here is just staggering. They posted a pre-tax margin of 38%.
38% is incredible.
And they captured $50 billion in long-term debt inflows. But the total scale is what really breaks the brain. Assets under management hit $5.1 trillion, and total client assets reached $7.7 trillion.
It's hard to even conceptualize that number.
Right. $7.7 trillion is larger than the GDP of almost every country on Earth, just sitting in one institution's wealth vault.
And the mechanism behind that 38% margin is pure scale. Asset management is just an incredibly scalable business.
Because you don't have to rebuild the machine for every new dollar.
Exactly. When you bring in $50 billion in net inflows, you don't need to hire $50 billion worth of new portfolio managers. The infrastructure is already built, so the fee revenue on those new assets drops almost entirely straight to the bottom line.
which is amazing. And that rounds out the current quarter, with the corporate segment reporting another $4.2 billion in net income on $6 billion in revenue. But then the text takes a hard pivot to the 2026 full-year outlook.
Yes, the forward guidance.
This forward guidance is where the math gets heavily scrutinized. They project total net income to be approximately $105.5 billion, with NIX markets around $96.5 billion.
Right.
But then we hit the expense line. The adjusted expense outlook is raised to approximately $107.5 billion.
A huge number.
So what does this all mean? The CFO attributes this to volume and revenue-related expenses. But looking at $107.5 billion in projected costs, I have to ask, is the firm silently bracing for a macroeconomic storm? Or is this just the brute force price tag of scaling a $7.7 trillion asset machine?
Well, this raises an important question about how markets often misinterpret forward guidance. It is incredibly tempting to see a $107.5 billion expense projection and just assume defensive posturing or operational bloat. But the text explicitly ties this to associated revenue outperformance.
So they are betting that the sheer volume of their 2026 business will be so massive that the processing, the compensation pools, and the execution costs just naturally inflate to that $107.5 billion mark.
Exactly. It isn't waste, it is capacity building. If they were bracing for a storm, you wouldn't see it in the expense line, you would see it in the credit metrics.
The defaults.
Yes, and that is why the very last metric the CFO provides is arguably the most critical piece of data in the entire report, the card net charge-off rate.
They project the card net charge-off rate for 2026 to be approximately 3.2%.
And Barnum explicitly states that this 3.2% projection reflects better than expected consumer credit performance.
So it's actually a good thing.
It is. The charge-off rate is the ultimate barometer of systemic distress. It is the percentage of their loan portfolio they expect to permanently write off because consumers have simply stopped paying.
So they are telling the market that despite the inflation, despite the high gas prices and the rising revolving balances, they expect default rates to remain remarkably stable and healthy.
Yes, and this is exactly why you, the listener, should care deeply about a 3.2% charge-off projection buried at the very bottom of a global banking report.
Because it's about them.
Exactly. Because this isn't just a corporate statistic. It is a multi-billion-dollar bet on your specific economic resilience.
That is wild to think about.
When a financial institution of this magnitude projects a healthy charge-off rate into 2026, they are modeling out the labor market, inflation curves, and wage growth, and concluding that you, the everyday consumer, will remain employed. You will continue to service your debt, and you will not break.
They are essentially betting on us.
They are not projecting a recessionary collapse at all. They are projecting durable consumer strength.
It's just a breathtaking balancing act when you step back and look at the structural picture this entire report paints.
It really is.
You have a deeply resilient consumer absorbing the friction of inflation, utilizing revolving debt in a way that drives massive bank revenue, and then you take that consumer liquidity and funnel it straight into Wall Street, financing aggressive M&A deals and capturing the fees on wild 86% volatility spikes in the equities market.
Yep.
And the sheer gravity of all that activity just consolidates into this highly efficient $7.7 trillion wealth management vault.
It is an ecosystem operating at peak dynamic tension. The structural strength of the macroeconomy is fully absorbing the micro strains on the ground.
But, it leaves us with one lingering tension, and this is the thought I want you to really mull over as you go about your week. The sources clearly show that everyday consumers are carrying higher revolving credit card balances to navigate this environment. And that behavior is a massive driver of the bank's record NII. Yet, simultaneously, the expected charge-off rate remains a highly optimistic 3.2%.
Which is the big contradiction.
Right. So how long can that specific delicate balance actually last? Are we looking at a fundamentally stronger, permanently evolved consumer base that simply knows how to manage higher debt loads in a modern economy? Or are we just looking at an economic cycle that hasn't quite hit its structural breaking point yet?
It's the million-dollar
Or the
question.
trillion-dollar question based on these numbers. As you look at your own checking accounts, your credit balances, and your investment portfolios heading into 2026, think about where you fit into that 3.2% calculation.
Yeah.
Are you quietly absorbing the inflation friction, or are you the resilient macro defense holding the entire global balance sheet together? It is definitely something to think about the next time you swipe that card.